Thank you so much for joining us today for Coffee with FourThought, our December 2025 year-end edition. We're very thankful to have you, and while people are getting in here, we'll just go ahead and do a friendly reminder about our disclosures. Everything that we talk about today is for informational and educational purposes only, should not be taken as personal financial advice. See our website for full disclosures, and as always, sit with your advisor to talk about anything with your particular situation. As a reminder, we are doing a Q&A session at the end of our webinar today. At the very bottom at that taskbar, you should find a Q&A button. Feel free to click it. We'll be monitoring that Q&A as we go. We will get to as many questions as we possibly can. Going to leave plenty of time for that at the end. If we cannot get to your question during our session today, do not worry. We will make sure to have one of our advisors reach out and get that question answered for you. So the more the merrier. We always encourage participation, so please take advantage of that Q&A down there at the bottom in the taskbar. My name is Joel Johnson. I am the Director of Financial Planning here with FourThought, and I'm very excited today to be joined by one of our planners, Brad Patton. He's taken Jake's spot as Jake is enjoying some family time. So Brad, welcome to your first Coffee with FourThought presentation.
I am excited to be here. I know I have big shoes to fill with Jake being gone, but I will do my very, very best.
I'm sure you'll do just fine, and we're going to have fun as we go through this. We got a lot to cover today. So what we're going to start with, of course, as always, is check in on what the markets did in November. We're going to go over the economy and check in on the Holy Grail, make sure that we get some updates on there. It's a weird one this time, so we're going to have a little bit of discussion there. And then Brad's going to really take a lot of time here. We think this is the perfect time for some year-end planning tips. And so we want to make sure that we go through our checklist with you. We've got a deliverable to hand to you. So we're going to spend plenty of time actually on planning topics today. But let's go ahead and start with the markets and what we saw in November. The big headline for us, tech really took a breath in November. If you see over there on the left, our indices over that month, international actually ended up outperforming once again. So it was up just over 0.6% for the month. The tech-heavy NASDAQ was down almost 1.5% for the month. It's had a great year, though. If you look over on the right, that's where we're looking year to date. You're seeing the NASDAQ there in the blue still up 22%, even with that pullback. And actually, international, even with all the craziness that's gone on, their year beginning of outperformance has held steady throughout the remainder of the year and continues to be the outperformer there. I will say that that is also very tech heavy because of a company called Broadcom, which is included in there. It has had an incredible year. It's really helped that benchmark. But overall, for the month of November, we did see quite a bit of pullback, and we're going to get into just why in just a second. But Brad, from your clients' perspectives, was anybody calling? Were you getting any questions about what we were seeing with some of the volatility we saw in November?
Yeah, clients, of course, are concerned when we have tariffs on, tariffs off, tariffs on again, tariffs off again. And that causes some chaos and some apprehension about what's happening in the markets. But as Joel has mentioned many times before, we just want to stay steady to the course and stay steady with our investment strategy. That has proven time and time again to be the best way to go about it.
Absolutely. And rebalance. We mentioned it the last 2 months, actually. This would be a perfect time to be looking at rebalancing, and we'll get to it more in the rebound or the year-end tips. But with these pullbacks, a lot of times there's opportunities. You don't want to just be rushing in. You want to be careful about it, but it does present opportunities in certain companies. So just keep that in mind. But if the market is down, that means that people are selling stocks. And if they're selling stocks, well, then where the heck is the money going? Well, that's what we're going to show here. So what this fund flows is, this is now through October. So this does not even include what we saw in November. But what you're seeing up there at the top is that bond funds are actually getting most of the inflows, and a lot of that is actually going to cash. That top line there of money market funds, 1 month, so just the month of October, was $1.34 billion went into money market funds. I think that a lot of that is people just taking chips off the table because we've had another great strong year. But then if you look at the rest of those, the core bond funds and the multi-sector income funds and those sorts of things, they all had very strong inflows as well. Why is that happening? I think we can tie that very much to what the Fed is doing and the expectations that they're going to continue to cut interest rates. So what people are trying to do is continue to get the yield while it's still there. We'll look at the yield curve in just a second here. but trying to get as much of that yield before they continue to cut interest rates. Market rates would expect to go down with that. So a lot of people have been taking chips off of the equity markets, moving it into either cash or bonds, which is fine in the short term. But like Brad said earlier, we want to make sure that we have your plan and your long-term asset allocation in mind first. We are not following this, but it's good to keep an eye on and understand what's happening in the markets. On the equity side of things, like I mentioned, a lot of selling. A big portion of that has been in the large cap growth space. Why? You've had an incredible year. Ever since the lows in April for large cap growth, which is very tech heavy, again, you can look at the NASDAQ and a couple of other indices there. Large cap growth has been the outperformer on the domestic side of things. When you have strong performance like that, a lot of folks, especially mutual funds, it will just rebalance. And as part of that, if you've had outperformance, you're going to have to sell the outperformers to put somewhere else. I think that is the vast majority of what we're seeing. I don't think necessarily it's a market call by these managers. It could be, but I don't think that's what we're seeing, especially as you get towards year end there. You're going to start seeing this more and more as people just kind of rebalancing their portfolios, taking chips off the table, and making sure that their risk is realigned with who they are as investors. Brad, did you have anything to add to any of that?
No, I think you've really hit on the big things that most clients are concerned about is because we have had a good year, despite all the somewhat chaos that we've had, is now a good time to take some of those chips off the table? And should we be a little bit more balanced in our approach? And it's a case by case basis, and we will certainly talk with each of our clients on that.
Absolutely. Absolutely. Now, the other thing that I like to look at on the equity side of things is the difference between active and passive. So when I say active and passive, I mean the management of those funds. So is the manager of that fund actively choosing stocks, or are they just passively investing in the index they're tied to? The common one there, of course, is the S&P 500, but there's a number of passive indices that you can get access to. And over that same time period, so through October, you're actually seeing the vast majority of the flows going towards passive investing, which is a little interesting for me because if you look at the indice, I'll pick on the S&P 500 right now. There are 7 names in that one index that make up the vast majority of the performance of it. It's worked extremely well over the last couple of years, really the last 3. Those 7 names, we all know them, the Mag 7, they've performed very, very well, and they've become a very large overweight in that S&P 500, which means every dollar that I'm putting into the S&P 500, let's call it 30 cents of that is going to go into 7 companies. The remaining 70 cents of that dollar are going to go into 493 companies, which means the inherent risk I have of putting it into the S&P 500 is that as long as those 7 companies keep doing great, I'm going to be a very happy investor. If we continue to see a pullback or we do see those companies start to underperform, I'm not going to be so happy, and active investing might actually outperform. There is place for both of these strategies in a portfolio overall, but when you're going into passive investing, especially with the advent of the internet and all the financial advice that you can get out there, be aware of what you're doing by moving to passive. Even going passive is an active decision by you as the individual investor. And Brad, I know for all of our clients, really, we do see a big mix of this. And so what are you hearing from your clients as far as the active versus passive argument?
Yeah, it's an ongoing argument. Everybody talks about it all the time, and there's been a lot of studies about active versus passive. We do believe active management can outperform over a long period of time, but in the short term, you have to deal with what is going on in the market. And as you mentioned already, Joel, those 7 companies are so dominant in the market these days that it's hard to get a really good feel for what active versus passive really means when only 7 companies are dominating that space.
Yeah, it's definitely something to keep an eye on. It's something we're talking with our clients about all the time. Again, there's room for both. Just understand the active decisions that you're making, regardless of which one you go with. So it's a little bit of an oxymoron there, but I think it's important to talk about. So the last thing we want to touch on as far as the markets go is the yield curve and just doing a quick check there. We've seen it steady out ever since the last Fed cut. We're going into December where we expect another rate cut. I think right now it's just over 85% probability is what's priced in that they're going to do another cut in December, but it's really not a given. If the Fed does not go in the direction that people think they will, you will see volatility in the yield curve. If they just kind of go with what's expected, then we'll probably see this kind of maintain itself. It's actually really leveled out over the last couple of months here. That's a good thing for the markets, and it's getting a little bit healthier. You're going to notice on the left-hand side, that short end of the curve, yields are still much higher than what they are if you, let's say, you go into a 30-year bond, but it's getting healthier. So as long as we continue to see that bond market get healthier as we get through this rate cutting cycle, as we continue to see what happens with tariffs, we just yesterday had some news about Japan potentially increasing their yields, which will strengthen the yen, and that will basically create more competition for investment dollars. So that's something to keep an eye on. So it's definitely not going to be a quiet end to the year. But what we're encouraging a lot of clients to do, especially with the way that we like to manage portfolios, is just reviewing it with your planner and making sure that your fixed income allocation is right where you want it to be as we go through all of this volatility, to make sure that we're getting the yields that we want while we have them. Again, if the Fed cuts in December and they continue to cut into 2026, you can expect these market yields to continue to come down as well. They only control that short end of the curve. Really, it's only up to a couple of months. Everything else is going to be market driven. And so as all of this plays out, you're going to see a big change in the yield curve. And we just want to make sure that everybody's prepared for that. Brad, you've been making a lot of changes to your fixed income portfolios.
Absolutely. We're looking at this very seriously. We're trying to anticipate what the Fed might do. But I think the real key element here is the Fed is weighing a lot of different factors as to whether or not they're going to do a rate cut. If we do see a surprise and they don't cut rates, that's where we're going to really see the impact to the yield curve.
Absolutely. Yep. So it's going to be an exciting end of the year, and we're going to be keeping a close eye on what the Federal Reserve does, and really the comments from Jerome Powell later this week. But they're in their quiet period, so not expecting a whole lot there. But you never know what you'll get from the Fed. Last thing here on the markets, we want to go ahead and check in on the economy. So you'll remember this as our holy grail, and it's looking at a couple of economic indicators that we think are valuable. Here's the weird thing about this one. We had a very long government shutdown, the longest in history, if I'm not mistaken, maybe the second. I'm pretty sure it was the longest, though. And so all of this economic data is now delayed. You'll notice that the latest period for a couple of these, housing starts, real GDP, and a few others, are actually pretty well delayed now. We're going to have to continue to wait on those, but we are starting to see more cracks in the economy. Not anything that's throwing up red flags yet, but we are seeing cracks. Anecdotally, I think we had all kind of assumed that the labor market was probably weakening. We've seen a lot of big name companies do massive layoffs. A few reasons for that potentially could have been overhiring during the COVID pandemic and kind of right sizing after we've settled out 5 years later. Another big one, of course, is efficiencies with AI. But essentially, all of that is wrapping up into our unemployment rate is now at 4.4%. That's a 10 basis point increase from the last reading we had 3 months ago. So a 2% increase, not terrible. It's actually still right around our full employment, but it is something to keep an eye on there. The other one that I'll point out is actually loan delinquencies have gone down. One of the things I was kind of expecting toward the end of the year is that to actually increase, but that means that the consumer is actually a little bit stronger than we thought, which is good news for the overall economy. But of course, we're coming into December. There's a lot of spending going on. I'm sure you've seen the headlines about Black Friday, Cyber Monday, and every other day that it seems to have turned into weeks now. But we'll see what happens with Christmas and other holiday spending through the end of the year and whether that has any impact on overall loan delinquencies for banks. That'll have a ripple effect, but we're not expecting any major changes. Brad, when you look at this, what metrics really stick out to you?
Well, I'm really focused on a little bit on the retail sales. Going into the holiday season, that is such an important period for a lot of businesses. And really, they're starting to feel the impacts of some of the tariffs and also doing appropriate price cutting and sale pricing as we go into that big, important part of the season. So I think I'm really focusing on retail sales and where they're going. And we've seen some positive impacts already from Black Friday through Cyber Monday. We'll see if that continues all the way through the season. And we have a little bit longer season this year than last year, so that might also help.
Yeah, absolutely. And then we're going to keep an eye out for when those housing starts and the real GDP growth does come out. Very curious to see what those numbers look like. And then hopefully we even out with the economic releases moving forward again. So earnings season is starting to come to a close here, and what we're showing here is our earnings scorecard. So before I jump into that, the one big earnings release that we actually just recently had was NVIDIA. So they had an absolute blowout quarter. They actually surprised on the earnings upside. Their revenue growth was incredible revenue growth. I mean, just across the board, it was one of those reports that when you read through the numbers, you're thinking, wow, this stock's got to be up. It's actually down. So since the release, it's down about 5% from their earnings release. And what I would call that is really being priced for perfection. And you're seeing that across the industry when it comes to these AI related stocks. Now, we're not calling for a bubble in the AI space, but you do want to be very selective about which companies you own in that space and at what prices you're buying, because when they are priced to perfection, even a blowout quarter does not necessarily translate to good performance moving forward. We see this every single year with these companies. We see it with companies going back as long as the stock market's been in place. We do think that there is some value to active investing by avoiding some of those companies who may not have earnings or not priced appropriately for what those earnings are expected to be. But Nvidia, wonderful earnings, wonderful company. We're not worried about it one bit. Long term, we think it's still going to be one of those companies that are going to continue to dominate the S&P 500. But we just wanted to point it out as strong results don't necessarily result in strong portfolio results. But as far as the earnings scorecard goes, you see we've got about 465 of the S&P 500 companies have reported. That's about 93%. And overall, it's really been a mixed quarter. You've seen about half of the companies beat their expectations and another half miss. Now, again, a lot of noise is going into this with what's going on in Washington, with tariffs, with all of these different things. But if you look at that IT sector there, you're going to notice 44% have actually missed their expectations. And that can be a number of things, but it's definitely one of the things that we're going to keep an eye on going into Q4 earnings, which will start in January. We're going to go through this again, go through the reports, and we have been making small changes inside of the portfolios to accommodate for what these companies have reported to us, but we're not making major calls or major asset allocation changes at this point. But earnings season almost over. I know Jake is on vacation to take a breather from all of it, but Brad, what have you seen in earnings and anything to add?
Yeah, so earnings have been a little bit of a surprise over this past quarter. You already mentioned IT, but I think healthcare is another area where there's a lot of uncertainty in the marketplace. And as prices may be going up related to the one big beautiful bill and some of the discounts that were out there, we may see some additional impacts in that area as well. So we're keeping a close eye on healthcare in addition to IT.
Mm-hmm. Yep. And what this is also doing, again, there are values out there. We are finding opportunities to put money to work for clients in stocks still. So that's kind of where this type of fundamental research is really valuable. And what we love to do as investors is digging into these companies and understanding what we own inside of our clients' portfolios. It's worked in the past. It'll continue to work in the future. And so that's just our philosophy. And we're excited to really, it's going to be consumer staples through the rest of the month and getting the rest of the S&P wrapped up here and then rolling right into Q4 results. So always busy on the earnings side. All right, so let's go ahead and switch gears here now. We touched on the markets, we touched on the economy. It is December, which means from a planning perspective, we have a lot to talk about. Brad, what should clients and other folks be looking at to do before year end?
Yeah, this time of year is really we start to think about what are all the things that we need to do by the end of the year. We're very busy this time of year looking at a lot of different things for our clients, and we wanted to just harp a little bit on some of the things that you can do and some of the things that we're doing to make year end a little bit better for you. The first one is realizing losses. We certainly are doing tax loss harvesting throughout our portfolios through the end of the year, trying to reduce any capital gains we've had. And as Joel's already mentioned multiple times, we had a lot of gains this year. So when we see something that's completely overvalued, we're looking for those opportunities for a few stocks that are maybe not performing as well and taking those losses where we can. Unfortunately, in a very good, strong market, there aren't that many opportunities to tax loss harvest, but we're certainly looking forward to any of those. Year-end capital gains. We do expect some mutual funds and ETFs to make distributions towards the end of the year. Again, it's been a very strong market, so some large end distributions could create some surprises for our clients. We want to make sure that we're trying to mitigate that as much as possible, and we may adjust our positions to reduce any exposures that are there. Probably the most important one that we run into day in, day out is your required minimum distributions. We are making sure that all of our clients take care of their RMDs that are with us and through Fidelity. However, a lot of our clients do have outside retirement accounts, and we do want to make sure that all of their RMDs are completed before December 31st. Probably most importantly, if you're using any qualified charitable distributions, those checks actually have to clear, not just be written, but actually have to clear before the end of the year. So check with your charities, make sure that they cash those checks in a timely manner so that we get all that taken care of for you. We also do keep a close eye on inherited IRAs just to make sure that those are taken as well. For any of you that are still working and out there able to make contributions to your IRAs, obviously you have time through April 15th to do that, but a lot of people like to do that by year end and make sure that they're making the contributions as appropriate. One of the big things that Joel and I have talked about quite a bit with our clients and all of us as financial planners is now a good time to convert to a Roth IRA. We'll go through on a case-by-case basis, do the analysis and determine where each client fits into that scenario, but any conversions do have to be completed by the end of the calendar year. And we want to always make sure that when we're doing the analysis that we're keeping a close eye on any impacts to Medicare premiums, any capital gains that you might have, IRMA, all those types of things. Joel, in the conversion to Roth, what have you been seeing?
I'm seeing us working with a lot of CPAs. It is a really strong strategy for the right folks in the right situation. And just like you mentioned, it is one of those things that you have to get done before the end of the year for it to count for the year in which you're doing the conversion. But there have been a lot of changes with IRAs, traditional IRAs, when you have to take money out. How it's taxed is actually the same, but basically when you have to take the money out, it's really been condensed on both when you start and when it eventually has to be withdrawn. And so Roth conversions are definitely a conversation that we're having with a lot of clients where it fits appropriately and working with their CPAs or tax preparers to make sure that we're not missing anything and that they sign off on it, that yes, this is a good strategy for our client. And then we go ahead and help implement. But yeah, got to be done before December 31st for it to count for 2025.
Yep. We know enough to be dangerous. We all stayed at Holiday Inn Expresses last night, but we will work closely with your CPA and tax advisor to make sure that we get that done before the end of the year. Just a couple of other things that we want to focus on, and these don't apply to everyone, but we certainly want to make sure that you're aware of them. Some clients have carry loss forwards, and we want to make sure that we're looking at those strategically throughout the end of the year. Any charitable contributions, as we probably all know, there are some changes coming with the One Big Beautiful Bill. So tax rates aren't going to sunset like we thought they might at this end of the year, but there are still some charitable contributions. You definitely want to get those in before 2026. Also, 529 contributions, if you're contributing to grandchildren or children's accounts, contribute to those as timely through the end of the year. There are a lot more flexibilities, and now we have the ability to convert to Roth later on. So again, contribute prior to the end of the year. Flexible spending accounts, FSA funds. We all know that these are use it or lose it. Check with your employer and make sure that you get anything eligible expenses put in before the end of the year. Estate plan review, always a good time at the end of the year to just make sure all of your estate planning documents are updated and where they need to be. If you've had any major life events throughout 2025, that's really, really a good time to look at those documents and make sure that they match to your financial goals and current laws. Other than that, there have been some changes with the One Big Beautiful Bill. We have communicated those in previous coffees with FourThought, so we've discussed that quite a bit. But if you have any specific questions, check with your financial planner, and we'll be happy to go over your individual situations. Anything else you'd like to add, Joel, as far as year-end tax planning or financial planning?
Yeah, just a little bit more color on a couple of these. So when we talked about that tax loss harvesting, realizing losses before the end of the year, please make sure that you coordinate that with us. There's a rule out there. It's called the wash sale rule. And what the wash sale rule says is that if you realize a loss, but you repurchase similar stocks somewhere else, it can be any other account. So if let's say, I'm going to pick on Comcast because that's one we just recently tax loss harvested for many clients. If I, as your planner, sell Comcast in one of your accounts that I manage for you, but then for some reason you have an outside managed account and they buy Comcast for you, that wash sale rule says you cannot realize that loss. There's a 30-day window in which I am not allowed to own any Comcast in any, or I'm sorry, I'm not allowed to purchase any Comcast in any of my accounts in order to realize that loss. So real careful coordination must be taken with realizing those losses so we don't run afoul of that rule. On the RMDs, if you inherited an IRA after Secure 2.0 went into effect in 2020, they have changed the game entirely. Inherited IRAs now, if you haven't been taking RMDs, you probably have to, not everybody, but please make sure you're reviewing that with your advisor to make sure that you understand the rules that apply to you. They are complex. We don't even like reading through them because there are just so many of them now, but it's our job to understand them and help to make sure that you're not running afoul of not taking RMDs and realizing any penalties moving forward. For the charitable contributions, if you are a high income earner and you itemize your deduction, which if you're a high income earner, I think we can assume you do, but especially if you're itemizing deductions and you're taking that charitable deduction, please get in touch with us to make sure that we're maximizing the 2025 contributions. We have many ways of doing it. There are minor changes going into effect in 2026 because of the One Big Beautiful Bill. We want to just make sure that we're maximizing from a tax perspective your entire financial picture. On the converting to Roth, like we already kind of talked about, we want to get with the CPA. It needs to be done before December 31st. Really like that strategy. The 529 plans for ultra high net worth clients, making sure that we're using up that annual gifting limit. And then the last one, and this is hitting a little close to home for me recently, reviewing the estate plan. It's a tough conversation. I just got my first estate plan signed with my wife, and I've been doing this for 15 years. So I understand that this is not the topic that everybody wants to talk about. But I want to kind of take it a step further here. And if you have any children over the age of 18, please encourage them to get an estate plan in place. Even something from one of the online providers is just fine, but getting a full set of basic documents in place as soon as you are 18 years old is imperative. Why does that matter to you as a potential parent? My kid's in college, he's doing just fine. God forbid he's in an accident. Having that healthcare release form in place is going to make things a lot easier while you're in a time of grief, on top of all of the other things that come with just a basic estate package. So if you have children over the age of 18 and they do not have a basic estate plan in place, that is a great gift to give for Christmas, even though it's not the most joyful one to be talking about. But again, even just an online provider, or we're happy to connect you with a qualified estate planning attorney to get that done. But aside from that, nothing else really. The move up medical expenses, that was the other one I wanted to make sure we talked about. If you've reached your out of pocket for this year because of an injury, or you had to spend some time in the hospital, whatever that is, and you've been putting off some elective surgeries or some elective procedures, it might make sense to go ahead and move those into 2025. You've already hit the out of pocket maximum. So just make sure you're kind of considering that. We're getting down to the end of the year. It might be hard to take advantage of that. I know we've been doing it, but just something to keep in mind as we kind of come to the close on 2025, which I cannot believe I'm saying. This year has flown by far too fast. So with all of that being said, that is the end of our presentation for today. We wanted to make sure that we left plenty of time for hopefully a very interactive Q&A session. As always, if you know of somebody who would benefit from hearing these conversations or sitting down with a FourThought advisor, we would be more than happy to provide them this information or forward to it or forward it to them, however you want to make sure that they get involved with these. We do them every single month, and we will look forward to seeing everybody in 2026. But like I said, let's go ahead and move to that Q&A session and make sure we get those questions answered for you. All right. Good morning, everybody. A very happy Thursday to you. Thank you so much for joining us. I got Brad here with me, and we're excited to dive into these questions. So you still have an opportunity to ask, buttons down there at the bottom. So if you got something burning in the back of your mind you want to make sure we talk about, please, please, please feel free to get it asked, and we'll do our best to get through as many as we can today. But Brad, we did have one come across while we were going through our presentation there. And the question was, do we anticipate doing more tax loss harvesting in IOP and others? You want to take that one for us?
Yeah, sure, Joel. Thanks. Yes, of course, we're going to do whatever tax loss harvesting we can. As we've talked about already throughout this presentation, but it's been a good year in the market, so there are going to be limited opportunities to really take tax loss harvesting. The one standout that we've had this year for tax loss harvesting is Comcast. So that is one of those stocks that we use. And just for a point of clarification, IOP, if you ever see that in any of our documents, it stands for Income Opportunities Portfolio, is one of our dividend income strategies. So we will continue to do that, and we'll monitor all the way up until December 31st to see what opportunities present themselves.
Yeah, and I think that's a really good point. And what I wanted to make sure we talked about too is when we talk about tax loss harvesting, it doesn't always make sense for every position. So if you've only got a couple dollars of loss, or what we really like to look at is percentage wise, if it's not a large percentage loss in that holding, again, you've got to wait 30 days before you buy it back. So there's potentially an opportunity for that to actually return in the next 30 days, what you would have loss harvested. So it's not every time you see a negative in a position, you really got to make sure it's going to be worth it and you don't expect to miss any performance during that 30-day window there. So just a point of clarification on that. We did have another one come up here. Online link to the website with estate planning basics to share with. Yeah, absolutely. Yeah, we're happy to do that there. We'll make sure that we get that over to you. Great. Okay. Uh, Brad, I got another one for you here. As we do go towards year end, one of the frustrations and really going into the new year too, that people always have is getting in front of their professionals when they want to and when they need to. And a lot of times that means just kind of wait until the very last minute. So any tips for the folks that are still with us today on how they might be able to not have that headache either going into year end or really into tax season, which is going to be on us before we even know it?
Yeah, that's a really good point, Joel. One of our best pieces of advice is start gathering your documents for tax season already. Start to get them in order, start figuring out what is important. So if you get all those documents, start gathering them now until the end of the year. Any of your charitable contributions, your QCDs, your qualified charitable distributions, any and all those types of things that you can gather between now and say the middle of January. When those tax documents start coming in fast and furious towards the end of January to early February, you're going to be in a lot less stressful position to start positioning those things to your tax advisor and getting those things out to them. So starting early is always the best.
Yeah, absolutely. We do our best here at FourThought to work with the other professionals in our clients' lives. So if we do have communication with your CPA, we try to make that as painless as possible for you. But I think that's a great tip in getting those documents early. That way you're not the person knocking on their door April 15th and trying to get that in. And again, it's coming before we even know it. Brad, did you have any questions coming up on your end?
No other questions. The one question that we always do get around this time of year is around Roth conversions. And we mentioned it a little bit earlier in the presentation, but it's worth repeating here is those do have to be completed by December 31st. So get with your financial planner and go over any of the strategies that would be appropriate. And let's get those knocked out before the end of the year if that's appropriate for your situation.
And we did just have another one come across my favorite topic, Bitcoin. So, are we looking or considering Bitcoin in some manner, and what sector do we see moving up in 2026? So, let's start with the Bitcoin conversation. Very investor specific on that. Fortunately, it's becoming much easier to gain exposure to Bitcoin through ETFs and other means for clients who are interested in having that exposure. But we always educate our clients going in eyes wide open of what we're actually getting into. So for certain clients, yes, we do have allocations to Bitcoin. Again, it's very specific to that individual. Broadly, no. The reason is it's just too volatile. I think we've seen it over the last couple of months here. So we keep seeing the headlines of it hitting all-time highs. I think it peaked somewhere just above 120,000. And within just a few weeks, you saw that pull down all the way back to 80, and we're back to 90. And that's just volatility that we're not comfortable putting in all client portfolios. But for those clients where it's appropriate, they can stomach the risk and they understand what they're getting into. Yes, we do have ways that we can add Bitcoin now to client portfolios. Again, where appropriate, not broadly across the board. So if that's something you're interested in talking to one of our planners about or your planner, please let us know. We're happy to dive into your specific situation on that. But I think that's a good broad discussion item there. And then as far as what we see in 2026 and which sectors we see increasing, that's always a hard call. But for me personally, and Brad, I'll let you opine on this as well. I think it's going to be continue to be technology. You need to be very careful about which part of that sector overall you're going to be playing in. Certain companies, again, if you're not making earnings, if they're priced to perfection, we talked about a couple of the things that worry us in that sector. But generally speaking, the opportunity inside of artificial intelligence and those large companies, those large tech companies to continue to improve their efficiencies is really going to continue to be a catalyst for the next couple of years. That doesn't mean we won't see volatility. So could we have a down year for the first part in tech? Absolutely. We will continue to have volatility. We're going to see a lot of volatility continue. But if I were to be a betting man for 2026, I think broadly speaking, I think technology continues to be the place where you want to have some of your money, but please stay broadly diversified because I've been wrong before, I'll be wrong again. Brad, what about you?
Well, I've been wrong too, so it goes both ways. But I think healthcare is going to be an interesting sector next year. There's a lot happening in that particular space with some of the regulatory aspects of it and what the administration's doing as far as subsidies and all go. That could be an interesting area to keep an eye on. I don't necessarily see it moving up, but it's going to be something that we keep a very, very close eye on and make tactical changes as appropriate.
Yeah. Yep, I agree with you. Those would be the two that we're looking at. And again, all of the managed strategies that we have for our clients, broadly diversified, have exposure to both of those sectors. So we're looking forward to taking advantage of those hopeful upswings there. All right. Well, I do not see any other questions on my end. Brad, anything else on yours?
I do not see any additional ones on my end either.
All right. Well, we aim for about 45 minutes. We did perfect for this one. So thank you everybody so much for joining us and for sending those questions. Again, if you know anybody who would benefit from listening to these, please let us know. And also there is a resource section down at the bottom where we have a couple of deliverables. We'll also try to get those out via email, but basically a year-end checklist. And again, highly encourage you to give us a call and get with one of our planners to talk about your specific situation because we can only do broad conversations here. But hopefully it was helpful for you, and we'll see you again in January.
Take care.